Stevens here. Wanted to let you know that Carl White and the Marketing Animals have their Loan Officer Freedom podcast. It's really pretty cool because that Carl White, he's one clever devil, and he really is clever. I mean that. One of the most clever people I've met in the mortgage business anywhere. He does interviews, has great free tips, so you should check it out. Seriously, you might find a little nugget there that helps you with your business. All you have to do is click this banner right over there, or if it's on Facebook or somewhere else, it's around here somewhere. On with the show.
Hey, Vsauce, Michael here.
This is actually kind of interesting. Citi just offered $362 billion in non-QM mortgage-backed securities originated by Impact Mortgage. It's interesting because this is Citi's first volley back into subprime loans since, we almost blew up the kitchen back in 2008. Why is Citi jumping back in? Here's the reason, guys. Because subprime, Alt-A, non-QM type of loans, whatever you want to call it, is the fastest growing segment of the mortgage market, but more so because its non-QM is now deemed not really that risky. Remember, you still have the ability to repay and all these things. Let me give you a quote. The report, coming from Citi's point of view, the report showed reduced compliance concerns, standardized reps and warrants, and more confidence surrounding their loan underwriting process are some of the reasons lenders are less concerned about originating non-QM loans going forward. Now, I don't know if you guys got the interview that I did with Tom Hutchins of Angel Oak a couple of days ago, but if, and it looks that way, the QM patch is not renewed with Fannie and Freddie, then all your borrowers with back-end ratios above 43% are going to be deemed non-QM and will have to go down non-Fannie and Freddie channels in order to get those mortgages. I mean, guys, this is huge. I mean, massive. How many of your clients right now have a back-end ratio over 43? Survey says every single one of them, even after the rate and term refi that you're doing right now. That means non-QM, massive today. Would it be a stretch to call it the standard for lending tomorrow? I mean, I don't see this happening because Fannie and Freddie have to do something. But right now, without this patch, every loan that's not FHA is going to be non-QM in 2 years. I'm not saying it's happening, but it's the road that we're on right now. Speaking of Fannie Mae, their home purchase sentiment index hit a highest point ever this last month. Now, the index is based on 6 factors from Fannie Mae's National Housing Survey, including whether respondents consider it a good time to buy or sell a home, expected changes in home prices and mortgage rates, confidence about not losing your job, and changes in household income. Right now, it's the highest it's ever been. So in spite of the recession and the old yield spread conversion people are all bullish on right now, housing seems to be doing really well, more so than the economy. Now get this, Fannie Mae expects 2 more rate cuts before a year's out. Now, this low rate environment, this is a market so many lenders have wanted, needed, and dreaded at the same time. So here's my question for you lenders out there right now. Have you kept up with the refinances? Have you done all the relevant marketing to keep your database yours? Meaning making the calls, the texts, the emails, the mailers, that type of thing. Because I know a bunch of brokers just hate it when the retail branch of a wholesale company sends mailers to your past clients, or even whoever's servicing that loan after it's been sold off, like 9 times. So I'm just asking, are you doing the marketing that you're supposed to, or is it just a Chinese fire drill with you right now? Because that's how big refi markets usually were for me, just running around like my head was on fire. Now understand, with 2 more rate cuts, it's going to get worse. According to my conversation with Barry Abib just a couple of days ago, we're probably going to see even lower rates than we have right now. And just yesterday, Fannie came out and said they expect 2 more rate cuts. From Fannie Mae's Senior Vice President and Chief Economist Doug Duncan, he says, the persistent trade tensions between the United States and China threaten to further reduce business investment, disrupt equity markets, degrade household wealth, and diminish consumer spending, the country's primary economic engine of late. To help shield financial markets, buoy consumers, and perhaps nudge inflation slightly higher, we now expect the Feds will cut interest rates by a 1/4 basis points 2 more times before 2019. Now, I know the Fed fund rate isn't a perfect indicator for mortgage rates, but it definitely shows us the direction this ship is headed. And my last point, I had a conversation with my good friend and realtor, Tony Raffin, just yesterday. The guy closed 200 transactions last year as a real estate agent, 200. And oh, by the way, it was a down year for him. So you should check out what he and the rest of my panel had to say. All you have to do is go to Brian Stevens on Facebook and check it out. Now, this got me thinking though, and we said this before, and it was touched on by Tony in my interview. All lenders right now have their heads buried in refinances, and that's great, and that's where you need to be. But understand Again, this is a time for an astute loan officer to pick off a bunch of referral partners from your competition and getting them into your listing booster account. Really, do that because I've got a slam dunk strategy to get agents for you. All you have to do if you want to check them out is jump onto my Monday morning live webinars at 10 o'clock. I do every Monday. And all you have to do is click the webinar link down here or somewhere around here. Hope this all helps, guys, and make it a great day. We'll catch you again tomorrow. Later.
Ba 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 ba